for joining, everyone. We're excited for the opportunity to provide our quarterly economic and market outlook update call. I'm excited to have members of our investment division, particularly our Chief Investment Officer, Bill Wallace. Many of you know, but just by way of brief introduction, Bill has been with Soltis since 2014. Serves currently as our Chief Investment Officer. Prior to joining Soltis, Bill's been in the business for right under 39 years. So we're excited to have Bill and to get a market update. We will record this call for participants that are not able to view it live. We will have a Q&A session at the end of this, at the end of the webinar. We'd like to invite you, if you go to the bottom of the meeting, you'll notice a Q&A box where you can submit a question, and so we'll host that Q&A toward the end of the call. So with that, Bill, thanks for joining us this morning. We'd like to turn the time over to you.
Thanks, Clark, and welcome everybody. We're excited for this quarter's update as we enter into a new year, and hope that you'll find the information that we provide today useful. We'll go through our economic and market outlook with some market fundamentals, talk a little bit about government policy and our outlook for gross domestic product growth. We'll shift gears and focus more on some investment themes and ideas that we've been working on. And as Clark says, we will take questions at the end of the meeting. Okay, there we go. Thank you. First off, just kind of looking at the markets from a valuation standpoint, you'll notice here in this slide, the average price earnings ratio for the last 25 years is just over 16 times earnings. And we are trading right now at just under 23 times earnings. And so from a price earnings standpoint, the equity markets do appear to be fully valued to somewhat overvalued. But as we go through today, I think you'll see we actually are still constructive on equity for 2021 in terms of its ability to deliver positive returns. One of the key reasons for our positive outlook for equities in the coming year is Federal Reserve monetary policy. And you'll see in this slide here, we're in this phase right now where the Federal Reserve has gone to near zero interest rates for the short-term part of the yield curve or maturity structure. Those low rates presents a very accommodative Federal Reserve policy. And that's one of the reasons why, despite a higher price earnings ratio than normal, we still think equities have a good outlook. Looking longer term interest rates, which is in some ways more important for equity valuation, you'll notice, of course, we've gone down historically to where we're at historically low interest rates. Right now, the 10-year Treasury note trades at about a 1 to 1.1% yield, which again is at historically low levels. We got quite a bit lower than this during 2020, with 10-year getting as low as about 0.5%, maybe even touch lower. So we've seen those rates trickle up, but nonetheless, when you look at these interest rates, it does make fixed income less attractive when you're comparing it to equities. I think this is another key component of our reasoning for having a positive outlook for the equity markets. You'll notice this is S&P earnings, corporate profits. These three bars here over to the far right give you an indication of what we're experiencing. You'll notice in 2020, we did have a drawdown in corporate profits. But one of the things that was interesting about the year, when the pandemic first hit, the market was pricing as if profits would go down about 80%. And as you can see here, profits for 2020 were relatively resilient compared to what we were experiencing in the economy and financial markets. So we're kind of working off of perhaps arguably a better base of corporate earnings. The forecasts for 2021 and 2022 are that corporate earnings will increase and hit new highs. So as we put a very low interest rate environment along with a positive outlook for corporate earnings, we feel that despite a high PE ratio now, we think that the market has an opportunity to move higher given those two factors of low interest rates and increasing earnings. Next, just for a little more out on the economy, you see here unemployment. We had a significant spike in unemployment during the worst parts of the pandemic, and we got up to about 14.8%. You'll notice here that we've moved down to about a 6.3% level. Unemployment's still an issue for the economy. We need to get more people back to work and back to jobs. We've had very good jobs growth to get from during the third and fourth quarters. We have had a little bit of slowdown in job growth here in the last month or so as the pandemic and the number of cases has risen significantly, and some government closures have come back into play. But we think that job growth will continue, and we'll see the unemployment rate trickle down over the coming year. This is a slide that we do. We essentially feel that government policy definitely matters, but we also realize that even more important than government policy is business and what's happening on in the business world. But since we know government policy matters, we've constructed this chart to give us an idea, and we really work hard here to be objective with these, whether we view something as positive, negative, or neutral. You'll notice here in the short term, we have monetary policy as accommodative. We've talked a little bit about that. We still are benefiting from the 2017 tax cut, in our opinion. So we can, as long as that tax cut and those tax rates are in place, we think that's a positive for government policy. We've actually moved spending to accommodative and a positive. We've had this as a negative. We are wary of growing government and the size of government. There's a balance between good government levels and what it can do. And if government gets too big, it tends to slow the pace of growth. But in the short term, next 6 to 12 months, we'll probably get another accommodative policy from the administration. And that could boost in the short term for a quarter or two, that could boost growth. We have moved regulatory policy to neutral. We were, to negative. We were neutral, and we just see the current administration coming in with a pretty aggressive executive order program, avoiding putting policies through the legislature for their input and approval. And the things that are the executive orders are increasing regulation. So we have that as a negative right now for government policy, and will probably be negative for some time. Neutral on trade policy, we still, we're just uncertain where the new administration will go with trade. We had this as a negative at times during the Trump administration. We're hopeful that the Biden administration may have a better outlook, a more free market oriented outlook on trade, but we'll see how that goes. So as of all things considered, we're at a slightly positive for our outlook for government policy in the next 6 to 12 months. We're going to get the fourth quarter GDP report. Matter of fact, it's this Thursday, but our outlook right now for GDP growth in the fourth quarter will be around the 5.2% range. That's a very attractive number. Keep in mind that growth has tended to hover around the 1.5% to 2% range. We did see growth at times during the Trump administration get up into the mid threes. And so this 5.2% number is very good. The economy is really recovering, and we think will continue to recover as we move forward. One of the things that we think will be interesting to monitor, the savings rate has gone up dramatically during the pandemic as consumers have hunkered down, become more conservative, and have been saving at very high levels. But there's also, we believe, pent-up demand. And once we get to more normal times, we think that, the pent-up demand that consumers will have will be another thing that could boost the economy going forward. We don't think that we'll see this kind of level of growth continuing. It will gradually come down, but nonetheless, we see positive economic growth for the coming 2021 and 2022. One of the items that we wanted to talk about, we talked a lot about and encouraged our clients to not get overly partisan on or let their politics have significant impact to their investments. And I think that's been validated as the markets have continued to go up with the election results and the election being over. I think part of that is just, there's uncertainties before an election, and after the election, some of those uncertainties go away. But we encourage, again, to think long-term in your investments. You'll notice here, this slide, Republicans are in red, Democrats are in blue, and gray is divided or combination of both parties. You can see here that more often than not, the equity markets increase, and cumulatively they increase. There are negative years, but again, cumulatively they increase. The economy tends to grow, whatever situation is, the economy tends to grow. I think our point would be is government policy can help economy grow faster or make that pace of growth slower depending on government policy, but it doesn't tend to make the economy not grow. So that would be our advice there, is think long term and don't let politics drive your investment decision making. Shifting gears a little bit now to more kind of investment ideas. One of the things that we've been doing in our portfolios, we allocate internationally, as you know. We have increased our allocation to emerging markets, and this chart kind of really tells it over here on the far right. Emerging markets did have about a 10% drawdown in earnings in 2020, but we're looking at a forecast of nearly 29% in earnings growth in the emerging markets. So we've worked to take advantage of that. We've recently increased our allocations to the emerging markets. Just so you're aware, our allocations to emerging markets tend to be in about the 3 to 7% range. They're never going to be a major part of a portfolio, but we do think it's an area that is growing faster than the rest of the world, and ultimately that will play into growing stock prices for emerging market companies. This next slide just also kind of is another validation of why we want to be invested internationally in portions of our portfolio. This is a slide that shows dollar weakness. It's the history of the dollar over the last number of years since 1975. You'll notice most recently there's been a decreasing value for the dollar. We think that likely will continue. Partly because of very aggressive monetary policy here in the US. But what happens when we invest internationally? We do not hedge our currency. So it's a way to diversify away from the US dollar. And so if the US dollar goes down, the value of our foreign investments go up even more. And so that is another one of the key reasons why we're attracted to international investments at this time. We mentioned in our last webinar our interest in mid-sized US companies. You know, when we last met, we were kind of right around here. This green thing, just basically, this is comparing mid-sized US company to large US company, and you're starting to see this outperformance, and we think that this outperformance of mid and small cap stocks versus US large company stocks has legs. And typically when it happens, these gray sections here are noting recessions, and so you can see that as you come out of recessions, these mid-cap stocks tend to do very well. And that's one of our reasons we have increased our weight to the mid-cap area in our asset allocation. We want to take some time to just review our manager selection process and just talk about, give a great example of a manager that we've used for quite a number of years. But I'd like to turn the time over to our Director of Research, Sean Woods, to run us through these items.
Thanks, Bill. So volatility in markets, it can lead to poor decision making, and for individual investors, for managers, none of us are immune to it. And in what could be a critical time, needing our best judgment, you know, knee-jerk reactions can lead us to make decisions we regret later. So having conviction in a fund or manager, it can serve as an anchor. It can provide stability in times of volatility. It can really help us make good decisions at those critical times. And you know, conviction in a fund or a manager, it can't be based on performance alone. Performance is going to lag at times, right? There's not a magic fund or a manager that outperforms all the time. You know, good luck. We haven't been able to find it. They're not out there. But strong performance is really a symptom of strength in a fund's, you know, their people, their process, their parent firm, and there's a lot of research to support this view. So, you know, at Soltis, we're looking for funds that we can build conviction in. We're looking for funds that we define as best in class, and we define that, as you can see on the slide, we define it as, you know, an investment with a reproducible and consistent process that leads to predictable outcomes. We call this our CPR. And so let me give you a real world example of this. In 2020, Artisan Midcap Growth had a fantastic year. They were up almost 59%. They outperformed their benchmark by a meager 23%. They beat the average mid-cap growth fund by almost 20%. They were ranked in the 15th percentile. That means that they outperformed 85% of the other managers in the mid-cap growth space. It was a great year, but it hasn't always been smooth sailing for this manager. In 2016, it was a hard year. The fund was down about 1%. They lagged their benchmark, by about 8%. They only outperformed 6% of the other managers in their space. And then 2017 came, and that wasn't much better on relative performance. They still had a good absolute performance, but their relative performance struggled. They lagged their benchmark by 5%. They were ranked in the 73rd percentile. A knee-jerk reaction that maybe even the easy decision at this point would have been to move on from Artisan. But when a manager underperforms, we view this really as a symptom of some other problem. And if we invest in managers that we have conviction in, we build conviction around their people, their process, and parent firm. When there's struggles, we go back and want to reaffirm or validate our conviction in those areas. So we look closely at the people, right? Has anything changed? Is the manager not as focused because he has other responsibilities? Has there been turnover in the analyst team? We look at their process. Is there been something that's changed in the way that they, select stocks, how they exit stocks? Something in that process. Is there been a change, a shift there? Are they having significant redemptions on the fund, causing them to sell stocks they wouldn't normally sell? And then we look at the parent firm. Has there been some kind of change in their parent firm that maybe threatens their ability to retain strong managers and analysts? So we go in depth on each of those areas when a fund that we have conviction is underperforming. And with Artisan, we couldn't find any significant changes that had happened. We made what was a tough decision then, is to stay with the manager because we have conviction and we knew that over the long term they could add alpha. And luckily we stayed with this manager. But when a manager struggles, that's where we go back to how did we determine to invest in the manager? Where did we have conviction? And if our conviction remains, then we stay. And in this example, it worked out. It won't always work out. We're not batting 1,000, but this is a great example of our process and maybe an insight for you as investors to know how we choose funds and investments.
Thanks, Sean. Appreciate that. I'd like to do here, this is a page where we summarize a lot of key metrics and things that we're monitoring. Many of these things we've kind of hit on already, but I did want to highlight a few that we haven't really talked about. We have geopolitical risks on here. We're highlighting just the China-US relationship is strained. China's becoming more aggressive and with its foreign policies. And, that's out there and is a known, but probably the biggest, you hear this term black swan events or something that just comes out of nowhere to upset the market. And the pandemic is a great example of that. Those are really impossible to forecast. And so one thing I would say about geopolitical risks is this is probably one of the areas where a unforeseen event could come and play havoc with the market. But typically speaking, it's going to be a short-term issue and things will work through and the market will get back to growing. I also wanted to make a plug for fixed income. I know with interest rates low, we're working hard to try to find alternatives, but we think it's important for for investors to remember that fixed income still provides stability in portfolios. So when we have the inevitable market correction, the market drawdown, fixed income is still there to provide that ballast in your portfolio. And depending on your risk tolerance level, whether it's lower and you need to have more in fixed income, or your risk tolerance is higher and you have less in fixed income, we still would encourage you to remember that fixed income plays an important role of diversifying your portfolios and reducing your overall risk. The last is maybe just to talk about healthcare policy. We know that we've got the vaccines coming out, which is, I think, faster than most had thought possible. We're now seeing the vaccines roll out, and of course, there's some hiccups with that. But nonetheless, that's a real positive for the markets. It's another reason to be, I think, upbeat about the economy doing well. But, you know, the vaccines, if there is continued problems with getting people vaccinated in a timely fashion, maybe that is a drag on economic performance ultimately. So hopefully we can start to see a continuation and maybe a more speedy delivery of vaccinations. I noticed this morning that Pfizer, which is one of the vaccinations which is being used, came out and announced that they think they can do up to 100 million vaccinations. I'm for blocking on the time frame, but I think it was like during the first quarter, and that's up from 80 million. So that was positive news to hear. So before we end, just maybe some summarizings of some of our key takeaways today. We think the economic recovery is in progress and is likely to continue. You know, unless we get some sort of broad mandate shutdown policy, I think we'll start to see as we get to warmer weather, maybe the vaccine, or excuse me, the number of cases will draw down, and hopefully we'll be able to move on from this. But nonetheless, the economic recovery is in progress. Government policy changes. We've got a new administration. They're going to want to make a lot of changes. So we think that those changes could be consequential in the coming 6 to 12 months. So we'll keep a close eye on that. Again, corporate profits. We think profits are likely to recover in 2021 and 2022 and potentially come to new highs in corporate profits. So one of our reasons for being positive on our equity outlook. Again, don't let election results affect your long-term investment plan. We do think that anticipated government policies could slow economic growth. The pace of growth could be slowed, but we don't think you know, growth will stop. And make a plug for the other side, the private side of our economy. Businesses, entrepreneurs, innovators, they find ways to move their companies along. They find ways to be inventive, and we really have a lot of confidence in that segment of our economy and being able to continue to find ways to grow despite, you know, whatever government policies come out. And so those are our key takeaways for today. Clark, with that, maybe we can turn it over and you can let us know if there's any questions in the queue.
Thank you, Bill, and thank you, Sean, for your thoughts and for your comments in your presentation. Again, for those that are attending the webinar, there's a Q&A feature at the bottom if you want to insert a question in there. Maybe while we're waiting for a question or two to come in, Bill, can you speak to capital market expectations, how the Soltis Investment Committee looks at the expectations of not only our firm, but of other firms, and how we kind of juxtapose those expectations long-term?
Yeah, it's interesting. The capital markets have been, for the most part, have been very strong for, you know, the last 10 years. Equity market returns have been very good with, you know, some significant drawdowns, but nonetheless, it's been a very good decade for equity returns. It's also been a very good decade for bond returns. As interest rates have come down, bonds have had very good total return situations. So in general, we do look at a variety of different places, think tanks, for example, Callan is a consultant we monitor, JP Morgan and others. And generally the capital market outlooks are, most are suggesting that if you look out the next 5 to 10 years, our expectations need to be lowered. With the really strong performance we've had in both equity and fixed income, we should maybe, for example, if you're expecting 10% on average in equities over a long time period, you probably need to ratchet that down to 7 or 8%. We've seen very strong fixed income returns. We're probably over, in the next 5 to 10 years, you're probably going to be thinking more in the range of 2 to 3%. And that does maybe, that's part of the reason why we've been more working harder to generate alternative investment opportunities for our clients, because we think alternatives can provide higher income in cases, and also maybe higher growth in other cases than you get out of traditional investments.
Thank you, Bill. Several good questions are coming in. Maybe first, can you address our outlook for inflationary trends?
Yes, I could maybe pop back to an inflation slide, and I'm glad that question was asked because I was going to mention it, and I neglected to. So this slide shows inflation, the real level of this here is the real rate or real return of bonds after you separate inflation. Inflation's been hovering around the 1.6%. I think I'm on the wrong slide here from what I wanted to look at. Well, anyway, inflation right now, it's been hovering in the 1 to 2% range for quite a few years. Sometimes it pops above 2%. We have in our summary chart here, regarding inflation, we think that the Fed policy potentially could move inflation up higher, just in the sense of very aggressive money supply growth. Money supply growth has been growing at the range of 25%. So we don't think it's like imminent, but we think over the next few years, perhaps we see inflation move higher, move into the 2% plus range. Another thing that could be interesting with inflation, I mentioned pent-up demand, as the economy improves and consumers are more willing to spend and move away from high savings. And then you add on that maybe supply channels that are kind of somewhat disrupted from the pandemic. You could see some cost push inflation as well, in addition to maybe some monetary inflation. So although we're not too concerned about inflation, the inflation genie getting out of the bottle short term, we do wonder if longer term we might see some higher inflation. There's also some significant demographic trends that are holding inflation down as the world population grows older and more mature. They tend to be, not as aggressive as spenders. So that can be a thing that holds inflation down. And then technological advancements tend to increase productivity, which also can hold inflation down. So pretty long answer there, but that's kind of our thinking on inflation right now.
Bill, a question we've got time for just a couple of questions, but the impact of the current administration's announcement to perhaps raise corporate tax rates or how do taxes factor into our analysis?
That's a great question, and maybe I'll run up to. So we are believers that lower taxes change behavior, and so we think the lower tax rates and the tax cut we got in 2017, particularly the corporate tax cut, has been very good for the economy. And Biden has come out clear, with the plan to raise taxes, and so I think our sense is that maybe that tax increase won't come until 2022. We think this year kind of tough to raise taxes in a pandemic environment. And there'll even be probably some Democrats that would say, we don't want to raise taxes right now. But we would envision a potential tax increase, perhaps next year. And we would view that as a negative in and of itself for economic growth. And so, like, for example, here, we would in that case move to a negative for that portion of government policy.
Thank you. I think going along with that question, of course, is there is a notion of that expansive federal economic policy can help boost growth, and so maybe there's kind of the balance between I'm trying to just kind of put a couple of these questions together, but expansive federal economic policy seems more expansive to boost growth, but then also managing and maintaining, the run up in government debt.
Right.
Comments there.
So our again, we've been negative. We basically view our government doesn't have a revenue problem. Our government has a spending problem. It spends, more than need be, in our opinion. But nonetheless, if Biden, and this is likely to come out here soon, I would assume, we'll get another package to a fiscal expansion, and so it means increased spending. We do believe that will be that's accommodative, so we got that as a positive for the economic outlook. Personally, our viewpoint is that a package where you give money to people to spend, it doesn't change behavior. The people got, even people that are fully employed got a check if you were, depending on your level of income. So they go out, they know this is probably a one-off. I'll go out and spend this and then I'm done. And so I think one of the key things we would argue is that's why we've got that accommodative policy negative longer term, because we think we think those are short-term boosts. We don't believe it changes behavior. And maybe one thing I could do, and I know I'm jumping around here on these slides, but just to maybe kind of understand our philosophy. We work really hard to be objective, but we believe that government at a base foundation is a critical component of a thriving and growing economy. And we've got a balance here, saying, good government really sets the table for an opportunity for an economy to grow. But ultimately, innovation and business, most job growth is going to come from the private sector. And so we want that to weigh heavier on the economy. And so there's a balance between the two. And the thing that disturbs us about the growing government debt and just growing government in general, like government as a percentage of gross domestic product, the larger government gets, the more it crowds out the private sector. And so there's a balance there that we try to monitor and watch. And so that's kind of what we will be monitoring here over the next 12 to 18 months. Hopefully that helps answer that question.
Thank you. Maybe this is kind of a fun question. as the new administration approaches maybe more green policies, what ideas does Soltis have, or the ideas of potentially investing in vehicles with infrastructure and battery manufacturers or other parts of this sector?
That's a great question. We are exploring those areas and trying to figure out how to benefit from those things. I would indicate there's already been some pretty substantial growth in those sectors in terms of stock return type of growth. We do have one of the things you're going to have with a Biden administration, it appears, is more of a desire to kind of, pick winners and losers in the business world through their government policies. So I think what I can say is we are monitoring that carefully and looking for opportunities. We can use exchange traded funds, for example, to get a very narrow focus on a sector. I think we would also, our base case too is that you're going to benefit just being invested in the S&P 500. You're going to benefit from a lot of these trends. And then our question is a money manager, is there a way for us to exploit those more so? And so again, we're actively looking at those opportunities and working to take advantage of them.
Maybe last question, and then we'll conclude. Question about our Soltis outlook for real estate as it relates to the next 12 to 24 months.
Great question. We actually just reviewed that in our investment committee meeting last Friday, and there's the outlook for real estate. I think right now we would say long-term thinking, it's not a bad time to have real estate or acquiring some real estate. But the macro outlook is still tough for real estate. But overall, I think, so we're underweight right now, slightly underweight our real estate allocation, reflecting kind of some tough hurdles for real estate. But nonetheless, we're still invested, and we think longer term, it'll be attractive. It's a good inflation hedge, and so that's where we are with real estate at present time.
Thank you. I think, again, appreciate all of the interest and the attendance on this call. This call was recorded for those who have desire to participate offline or weren't able to make it. We welcome the opportunity to visit with each and every one of you individually with your various advisors, and appreciate this opportunity. We look forward to the next call in 90 days and monitoring the progress that we see over that period of time. But thank you everyone for joining this call, and we'll go ahead and conclude.